Your money-making broadcast starts now. Welcome back. Markets closed mixed on Wednesday, May 13th. The S&P 500, tracking the SPY ETF, managed a modest gain of 56 basis points, closing at $742.31, while the TSX waffled around the flatline. Oil held above $90 a barrel, energy stocks flexed their muscle, and a major sell-off in Canada's biggest tech name has everyone asking, is this a buying opportunity or a warning sign? We also got wholesale inflation data that came in hot. Ford unveiled a massive new business line, and the loonie keeps sliding. Let's dig into what matters for Canadian investors today. Let's start with the story that rattled Canadian tech investors today. Shopify, Canada's largest company by market cap, headquartered right in Ottawa, plunged 4.45% to close at $95.40. That's a heavy single-day drop for a stock that's already been through the ringer over the past few years. The sell-off dragged the TSX technology sector down with it, and for anyone holding Canadian tech, it was an unpleasant session. But here's the thing. Shopify is not a broken company. Far from it. They power millions of online stores globally. Their merchant base continues to grow. Their revenue trajectory, while not as explosive as the pandemic-era boom, remains solid. They're the dominant e-commerce infrastructure provider for small and medium businesses, and they're expanding into enterprise-grade solutions, cross-border commerce, and AI-powered tools that help merchants run their operations more efficiently. The fundamentals haven't changed. What changed is sentiment, and sentiment-driven sell-offs have a way of creating opportunities for disciplined investors. Now, if you're the kind of investor who follows the philosophy of the everyday stock picker, Peter Lynch, you look at a name like Shopify and you think, by what you know. Lynch famously argued that individual investors can find winning stocks in the companies and products they encounter in daily life. If you run a small business, if you shop online, if you've ever set up a store on Shopify's platform, you know firsthand how sticky and essential their product is. A 4.45% sell-off on no company-specific bad news. That's the kind of dip that attracts value-minded buyers. He would say that Shopify's dominance in e-commerce infrastructure makes this pullback worth a second look. Let's pivot to a story that actually moved the tape in the United States, but has major implications for Canada. Ford Motor Company surged 13.18% today after announcing the launch of Ford Energy, a new subsidiary focused on battery storage solutions. This is a big deal. Ford is taking its expertise in electrification and powertrain technology and applying it to stationary energy storage. Think massive batteries that can store power from the grid and discharge it when demand spikes. This is the same technology that underpins vehicle-to-grid integration, home backup systems, and utility-scale storage. Why does this matter for Canadian investors? Because Canada's auto parts sector is deeply integrated with the North American supply chain. Companies like Magna International, Linamar, and Martinrea International all supply components to Ford and other automakers. If Ford is doubling down on energy storage, the demand for battery components, thermal management systems, and power electronics is going to increase. Canadian suppliers that have already pivoted toward EV and battery-related production stand to benefit. And more broadly, Ford's move signals that the electrification story is not dead, it's evolving from vehicle electrification into broader energy infrastructure. Now, the economic data that landed this morning. The Producer Price Index, or PPI, which measures wholesale inflation, the prices businesses pay for goods before they reach consumers, came in at a year-over-year increase of 6%. That is hot. And it comes on the heels of last week's Consumer Price Index reading of 3.8%. Taken together, these numbers paint a picture of stubborn, persistent inflationary pressure in the pipeline. For the Bank of Canada, this creates a genuine dilemma. Import inflation remains elevated because of the weak Canadian dollar and global supply chain costs. But the domestic economy is showing clear signs of softness. Consumer spending is under pressure. Housing activity is sluggish. Business investment is cautious. The Bank of Canada has to weigh these competing forces: high inflation that argues for holding rates steady or even hiking, and a weak domestic economy that argues for cutting. The market is beginning to price in the possibility that the Bank of Canada cuts rates even if the Federal Reserve doesn't. That divergence would put even more pressure on the loonie, but it could provide relief for Canadian borrowers and businesses. Let's talk about the sector that kept the TSX from falling apart today: energy. Enbridge closed at $55.19, up 64 basis points. Suncor Energy finished at $66.07, down about 0.75%, essentially flat. The reason the energy sector is holding up is simple: oil above $90 a barrel. Canadian producers are among the lowest-cost oil producers in the world. When oil prices are this strong, cash flows are robust, dividends are secure, and balance sheets improve. The father of modern value investing, Benjamin Graham, would look at Enbridge and see exactly the kind of stock he spent his career advocating for. Graham's entire framework was built around the concept of margin of safety, buying assets for less than their intrinsic worth, with a buffer that protects you from downside. Enbridge is a pipeline company. It moves essential energy resources across the continent. Its revenue is largely regulated or contracted, which means it's predictable and recurring. It pays a dividend yield north of 6%. That's the kind of safety, reliability, and income that Graham built his approach around. He would say that when you can buy an essential infrastructure asset with a 6% yield and a long track record of dividend growth, you're not speculating, you're investing. Now let's look at Suncor through a different lens. The global contrarian investor, John Templeton, was famous for buying at the point of maximum pessimism, going against the crowd when fear was highest and opportunity was greatest. He would look at Suncor at $66.07 with oil above $90 and see a contrarian setup. Here's why. Canadian energy has been out of favor for years. ESG mandates, institutional divestment, policy headwinds, it's been a tough environment. But oil is a commodity the world still needs, and Canadian producers have some of the strictest environmental standards and lowest production costs globally. When everyone is running away from energy, the contrarian buys. Templeton would argue that when you combine strong commodity prices, disciplined capital allocation, and widespread neglect, you get the recipe for outsized returns. Staying with energy adjacent but with a very different thesis, let's talk about Cameco, which closed at $115.39, down 1.32%. Cameco is the world's largest publicly traded uranium producer. And uranium is having a moment. The nuclear renaissance is real, it's being driven by the need for baseload clean power, by the rise of artificial intelligence and the massive data centers that need constant electricity, and by government policies that explicitly support nuclear energy as part of the net zero transition. The disruptive innovation investor, Cathie Wood, would look at Cameco and see exactly the kind of transformative opportunity she builds her portfolio around. Wood invests in technologies that she believes will change the way the world works. Nuclear energy is having a resurgence precisely because it solves a problem that solar and wind cannot solve on their own: reliable, 24/7 carbon-free electricity. AI data centers need power every second of every day. Nuclear provides that. Small modular reactors are opening up new use cases. Cameco sits at the center of the uranium supply chain, and supply is constrained. She would argue that the market is not fully pricing in how essential nuclear will be to the energy mix of the next decade. Now, let's zoom out and look at the macro picture. On the trade front, there were encouraging signals today. Trump is in China, and market participants are increasingly expecting a tariff truce extension. That would be a positive development for the global economy generally, and for Canada specifically. Canadian exports are closely tied to the health of the North American trading bloc, and any reduction in tariff uncertainty is good for business confidence. By contrast, we saw data showing that UK exports to the United States plunged 25%, a reminder of what happens when trade relationships break down. Canada has reason to want a more stable and predictable trading environment. At the same time, the Canadian dollar is under pressure. The US dollar remains strong, and the loonie is feeling the weight. A weaker Canadian dollar is a double-edged sword. On the positive side, it makes Canadian exports more competitive. Canadian manufacturers, lumber producers, energy exporters, and agricultural companies all benefit when the loonie is lower because their products become cheaper for foreign buyers. On the negative side, a weak loonie makes everything Canada imports more expensive, and we import a lot. Food, machinery, electronics, consumer goods, all of those prices go up when the dollar drops, feeding domestic inflation. For portfolios, this means Canadian stocks with US dollar revenue, like Shopify, like Enbridge, like many TSX-listed companies, get a natural tailwind when their earnings are translated back into Canadian dollars. The weak loonie also makes Canadian dividend stocks more attractive to foreign investors. When you can buy a Canadian stock yielding 5 or 6% and the currency is cheap, you get a 2-for-1, the dividend yield plus potential currency appreciation if the loonie eventually recovers. That dynamic is drawing attention back to Canada's high-yield names. Enbridge, BCE, TELUS, the major banks, all of these offer dividends that look compelling in a world where risk-free rates are still elevated but starting to come down. Canadian dividends are becoming popular again, and that flow could accelerate if the Bank of Canada starts cutting before the Fed. Let's circle back to our stock picks and frame them through the lens of different investment philosophies, because that's how you build a portfolio that works in any environment. For Shopify at $95.40 after a 4.45% sell-off, the everyday stock picker, I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.